I don't know if you just heard Jerome Powell talk to the rest of the country from the Fed, but if you did, you must be happy. I think everybody was really happy with that call. Even Kathy Wood might have been happy with that call. This is Randy Kirk, and let's talk about what the Fed just said. If you like content like this, you know what to do. Like and subscribe. Please join Patreon, but most of all, send me comments. What did you think about what Jerome Powell just said? Did you think it was as bullish as the market thought? And what do you think was left out of that meeting that you would have liked to have heard? Anyway, let's talk about what did go down. I thought the most interesting thing of the entire call was when Jerome Powell acknowledged the fact that the bond market is behind or ahead of him, I guess you would say, in terms of where inflation is headed. So we've been talking about it in multiple videos that I've done in the past. Kathy Wood's been talking about it for at least 2, maybe 3 months, that the bond market doesn't believe it. The bond market doesn't believe that inflation is at the level that the Fed does. And that fact alone should give us some indication of why maybe the Fed softened their tone so much today. So that would be number one. Number one is that acknowledgement. Number two, the acknowledgement that there is a lagging indicator with regard to this 60% sector that he keeps talking about, which has to do with housing and rents, and that he's hoping that rents will go down in the future. Now, there's at least a possibility that rents will go down in the future, and apparently they're seeing some of that in the pipeline because there are a lot of new rental properties coming online, new buildings that are popping up around the country, not in all markets, but in plenty of markets. There does seem to be maybe enough inventory coming on board that maybe we would see a reduction. But this has nothing to do with his policy. This has nothing to do with Fed policy. It has to do with supply demand. The only thing that Fed policy could be doing to rents would be, by increasing interest rates, would be increasing rents, because the landlord is paying higher interest rate, and he's going to have to increase the rents. Well, I know he knows this. He's not dumb. We think, or at least the body as a whole, somebody in the room should be able to say, if we raise interest rates, it's going to potentially raise rents. Okay, I'll settle down on that. The reality is they're seeing that as a lagging indicator. They're saying it's in the pipeline that those future leases, that new leases might be at lower amounts. What if they're just at even amounts? That would be pretty good, actually. That would say if we got to 0 and they didn't see a bunch of increases in the rates of new leases, that would be a definite positive. They did acknowledge that the goods numbers are down, that the cost of goods is actually falling, and that's offsetting some of the stuff that's happening in services. So that was really positive information, made everybody smile. He said he thinks that goods will start to come back up to 0. So in other words, where we've seen deflation in goods, that we would start to see that coming more towards where there's no inflation or deflation, and that it would be, he thinks the long-term trend in goods inflation is around 0. I think that we'll continue to see some deflation, maybe not forever, but certainly more along this year. We're going to still see some deflation there because transportation has come down dramatically, especially the shipping containers from China have come down. They were like $16,000, $17,000 a container. They're down back to normal, like $2,000, $2,500 a container. So those kinds of things, with freight rates coming down, with oil coming down, oil came down another $2 today. I think that we're going to still see these kinds of things that will ripple through the economy, and we'll continue to see goods coming down somewhat over the next at least few months. And maybe, I think maybe I'm not in disagreement with Powell that long-term, no inflation in goods, no significant inflation in goods. I think we'll see oil coming down fairly substantially starting maybe next year. I'm not saying that I would short oil, but I think that the electrification of the world is ramping very rapidly, and at some point it's going to have an effect on demand on oil. Tony Seba, Kathy Wood, and others are saying that we've reached peak oil, not meaning peak in terms of what's available, but rather saying peak oil in terms of the demand for oil has peaked. If the demand for oil is peaked, then the demand starts to come down. Only one thing can happen when that happens, and that is that you're going to have deflation in the oil pricing. And that ripples right through the economy. Everything made of plastic, all transportation for at least the next few years, so many different areas of foods, agriculture, fertilizers. It goes on and on and on. As the price of oil comes down, it affects the entire economy. And you would also see gas prices coming down at the same time for both reasons. Number one, less demand for oil drives oil prices down. That makes people switch from oil to gas when they can, if the value of gas is better. For instance, in plastics, many plastics, you could either use oil-based plastic or natural gas-based plastics, and that you can switch based on which one is more or less expensive at the time. And when that happens, of course, that drives the gas prices down. So I think we're going to see continued deflation for a while in product prices. Long term, 3, 4, 5 years from now, yes, we see lots of deflation because not of anything bad, but we see deflation because of all of the efficiencies that are coming into the system. So those are several of the things that were talked about today. And then with regard to the future of the price of the increases in rates, he waffled and way back and forth and back and forth. The market a couple of times thought he was saying, no, there's going to be more and more of these 25 basis points increases. At the end of the day, I think the market seemed to believe that this could be the last one, that there could be at least a pause in March, that if there is an increase in March, that there would definitely be a pause after that. I think that's where the market is. But quite frankly, if they start these 25 basis point increases and the bond market doesn't move, I mean, the bond market literally went down today. It's still sitting under 3.5 on the 10-year. I don't think that we're too terribly worried about the Fed's efforts, because the bond market is going to have a greater effect. The T-bill, the actual Fed rate, the federal bonds, as well as corporate bonds are staying low. So that's going to have more of an effect in terms of how the economy is responding. There was some really good commentary in terms of maybe there doesn't need to be any higher unemployment rate in order to get us to the 2% inflation rate. I think that may very well be. If my long-term analysis of this recession is correct, this recession had nothing to do with the typical comings and goings of an economy. I've studied recessions for 40 years. I've written a book on recessions. This was a recession like no other, and Chairman Powell also said that was true. This was not like any other recession. It was based on restricted demand with restricted supply with outrageous demand, no place for people to spend their money. It's a completely different kind of recession that was created by this demand supply problem over the last 2 or 3 years. Those issues has gone away, so we should normalize. And as we normalize, we're still sitting here, he said, with 1.9 job opportunities for every one person looking for work. That's historically crazy numbers. So it's a little hard to imagine the unemployment rate going much higher. So soft landing, if we have a soft landing, if people aren't unemployed, they're going to continue to spend. The economy is not going to slow. We're not going to be looking at a recession. And the market seemed to love this optimism from the chairman. I'm with him. I think that when we hear from Kathy on Friday, I think that we're going to hear that she's very excited by this recognition by the Fed finally that this is a different kind of inflation and that it's time to maybe ease back. And anyway, if you like the content, please like, I'm excited. I'm enthusiastic, and it's been great talking to you.